Hello, I'm Roger Groh. How do you determine the right time to buy a stock or what that really means in terms of value? Well, if you listen to the masters in the business, Warren Buffett, for instance, it's not so much the price of that stock today, but it's the value that is going to be present in that company 5 years from now and 10 years from now. What does value mean? Well, it means the value of the projected cash flow looking out over that time period. How do you figure that out? Well, we're a chicken investor. We tend to buy companies that sell more every year of whatever it is that they sell, even during bad times. What are those types of products? Well, we all know them. You're probably going to continue to buy soap, for example. You're probably going to continue to pay your electric bill. You're probably going to continue to have your phone or your cell phone available for you to use. You're probably going to continue to pay your cable bill. And for most of us, we're probably going to continue to pay our mortgages. So those are examples of businesses which are likely to grow continually, even when things get tough. What doesn't do well? Well, when things get tough, we don't buy new cars. Most of us don't buy new houses. And so those businesses tend to be very volatile. We've chosen not to bet in those areas, but to buy companies that sell more continually of whatever it is that they make. Now, how can you increase the likelihood that you're going to make money? Well, there is going to be more growth in countries outside the United States over the next 20 years than in the U.S. The reason is we're getting old. We have too much debt. And as we get older, we're going to be looking to pare down debt. That means there's not going to be a whole lot of growth here. But as you look in China, as you look in India, as examples with countries between them with 2.5 billion people, where people don't have the basics yet, well, that represents a tremendous growth opportunity. Examples might be you can go and you can buy a franchise in Wendy's or Burger King or McDonald's. You'll probably pay 1 times gross revenue or maybe 6 to 10 times cash flow for that franchise. Why is that interesting? Because those prices are not likely to fluctuate as much as public companies will. On the other hand, you can also just go buy the stock in McDonald's or Wendy's for that matter. If you do that, you don't have to run it. You can be a lot lazier and just own the common. And therefore, in my mind, that should sell at a premium to owning the entire franchise where you really have to work. Now, the issue is how much of a premium? If you're lucky, you can buy the common stock at the same price as buying the franchise. It's rare, but it does happen. That would be a great time to be a buyer. In all likelihood, now's a great time to begin to slowly average into that sector. Slowly. Their business has been pretty good, especially in the case of McDonald's over the last year, despite the recession. And they've shown in past recessions the ability to drive demand even when, in general, people are spending less. You can bank on them. I'm Roger Groh, and I hope that helps a little bit.